deposits at commercial banks. And commercial banks also lend out that money to make a profit for themselves. It's very important for the stability of the banking system that they have enough equity, so enough capital, to protect themselves against the risks in their balance sheets and then to protect us as depositors. In the 1980s, some of the world's largest banks were heavily involved in lending to developing countries. They didn't get the money back on time. In some cases, they didn't get the money back at all. Probably for just a few quarters in 1982, 83 and 84, these banks, strictly speaking, were bust. They didn't have enough capital. They were bust. They couldn't, strictly speaking, really repay their depositors if push had come to shove. In the late 1980s, international rules were imposed on the large banks to have enough capital to meet this kind of problem. These were called the Basel I rules because they were enforced by the Bank for International Settlements in Basel, Switzerland. There was then an evolution of these rules in the 1990s, the so-called Basel II rules. And then we had a further bout of trouble in 2007, 2008 and 2009. The authorities decided to tighten the rules even further. And so we now have a regime called Basel III, which roughly speaking requires the banks, big banks mostly, to have capital relative to assets about 75% higher than before 2008.